As we approach the midpoint of the year, it's time to revisit Voya's biannual fixed income investment themes. So, for today's discussion, instead of going through all of the themes, we wanted to focus on what our views diverge from the broader market consensus and really what that means for portfolio positioning. So, on Aranjan, conventional wisdom would suggest that when rate volatility is elevated like it is today, it's prudent to keep duration positioning closer to neutral. How are you thinking about duration at these current levels, and where, if anywhere, are you seeing opportunities to either lean in or stay a little bit more cautious as it relates to our interest rate risk in portfolios today?
We really like the front end of the US Treasury curve given the valuation and fundamentals. Two-year Treasury yields have moved by 80 basis points since lows in February, and market is now pricing two hikes by end of this year. We think that the inflation uptick, which we saw recently, is largely driven by energy shocks and tariff increase prices we saw last year, which should fade away as the year goes on. Also, the lower real disposable income in the second half will hurt consumption a little bit. But most importantly, we haven't seen wage uptick yet, and we don't expect it to on looking forward basis given lack of churn in the data. And all these things has kept the inflation expectations anchored both on survey and market-based measures. And in our view, that should give Fed enough breathing room and will not force them to hike the rates this year.
So, to summarize, our view really is informed more about what's going on in the inflation markets rather than the labor markets. And with inflation being well anchored and maybe seeing more cyclical pressure rather than structural, and not a lot of pressure on real wages, leads us down this path where duration sounds like it's more of a value generator today than it was maybe in prior cycles.
Absolutely.
One of the other key topics in the markets today really is centered on artificial intelligence. How do you think about that dynamic today? Is this something more durable and structural, or is this something more bubble like where investors should be a little bit more cautious?
Yes, Brett, absolutely. AI capex has been strong, and we expect it to get stronger over next couple years at least. And the productivity gains coming from these investments, in our opinion, should be meaningful. In terms of what we are watching for signs of a bubble, I would point to three factors. First is when these firms start signaling reduction in capex. Second is if we don't see enough productivity harvesting from these investments. And lastly, if we don't see revenue and profit monetization from these investments. At that moment, investors will run out of patience.
So, just to close things out today, when investors are putting capital to work, certainly valuations are tight, and there continues to be this geopolitical uncertainty feeding really into this portfolio construction today. How are we managing risk exposures in a way that informs our positioning without relying too heavily on these forward looking macro predictions?
While spreads are tight and valuation is not attractive, elevated yield structure does provide good source of income. And we expect growth to be strong, driven by wealth effect, AI investments, which you mentioned, and strong labor market. And in that context, we have identified front-end high yield and high quality securitized as good source of income. Now, as you mentioned, this pursuit of self-sufficiency because of geopolitical risks in form of reshoring, defense spending, or supply chain independence do create risk of misallocation or policy error, which have created a little bit of fat left tail. In order to account for that, we are positioning in high quality bonds and also looking at select real assets across both public and private assets.
So while we're waiting for valuations to come our way, given the all-in yield level, certainly the income generating opportunity seems to be an incredibly valuable source of portfolio return today. For a deeper view into Voya's second half fixed income themes, those can be found on Voya's website. Thank you, everyone.